All right, let's dive into something pretty essential for, understanding how companies really pick. Have you ever wondered how these big businesses check their financial health throughout the year without waiting for that huge annual checkup?
Yeah, exactly.
It's like getting a quick but really crucial financial snapshot in between the big audits.
Precisely. And today, that's our deep dive. Interim financial reviews. This isn't just some, obscure accounting term. It's a vital piece of the financial transparency puzzle. We're going to unpack what these reviews actually are, why they're so important, and what auditors are really looking for when they do them.
Okay, and our mission here is to give you a real shortcut to understanding this critical aspect of financial reporting. You'll hopefully walk away with those aha moments about how these reviews differ from full audits and why that difference, well, it really matters for anyone looking at a company's numbers.
Yeah.
We want to make a complex topic feel clear and, actionable for you.
Sounds good.
So let's start right at the beginning. What exactly does interim mean when we're talking finances?
Simply put, interim refers to financial information that covers a period shorter than a full fiscal year. It could be quarterly, semi-annually, even a different 12-month period that just doesn't line up with their main fiscal year end.
Okay.
Think of it as those routine financial checkups a company gets between their big, comprehensive annual audits.
So it's like a mid-season report card for a company's finances.
That's a perfect analogy. Yeah, a mid-season report card.
Got it. Now, who actually needs one of these? Is this a requirement for every single company out there?
No, definitely not for everyone. And the rules are pretty distinct, depending on whether a company is public or private.
Okay, how so?
Well, for private companies, what we often call non-issuers, an auditor typically does a review if, say, their latest annual statements were already audited, and the same auditor is either lined up for the current year's audit or handled the last one.
Right.
Plus, the interim info needs to be presented consistently using the same accounting rules as the annual statements. And importantly, it usually includes a clear note.
A note saying what?
Saying something like, this is not a complete financial statement, and you really should read it alongside the latest annual audited report. It's all about context for those private companies.
Makes sense. And what about the big players, the public companies? I hear the SEC gets involved there.
That's right. For public companies or issuers, the SEC actually mandates these reviews in certain situations. If a company is required to file quarterly reports like Form 10Q,
Yeah.
an independent auditor must review that information before it gets filed.
Ah, okay. So it adds a layer of credibility.
Exactly. For those quarterly numbers the public relies on. And even if a company includes selected quarterly data, say, in its annual report, that specific quarterly data needs to have been reviewed too.
Okay, so if a public company goes through this review, is there always a physical written report from the auditor afterwards?
Surprisingly, not always. The actual auditing standards don't always require a separate written report just for the interim review itself.
Oh, interesting.
However, and this is the crucial part, if a company states anywhere, like in an SEC filing or maybe a report to shareholders, that their interim financials have been reviewed by an auditor,
Then what?
then that auditor's review report must be included right there in that same document. The SEC is very clear on this.
Ah, okay. So if you mention it, you have to show the proof.
Pretty much. It's like saying, if you're going to tell everyone we checked it, you better show them the actual checked sticker, from the professional.
Fascinating. Okay, so we know what it is, who needs it, but when a company actually has this review done, what's the auditor's game plan? What do they actually do?
Well, it's a structured process, but definitely not as exhaustive as a full audit. Auditors follow a kind of playbook with procedures designed to give them what's called limited assurance.
Limited assurance. Okay.
Yeah. Think of it more like a series of targeted checks and questions rather than a deep forensic dive, Broadly, they focus on understanding the client, asking key questions, analyzing the numbers, and then communicating what they find.
All right, let's unpack that playbook. What happens even before they start looking at the numbers? Setting the ground rules, maybe.
Absolutely. Before an auditor even agrees to take the job, they need to make sure everyone's on the same page. They check if the company's using a standard, acceptable set of accounting rules, and critically, they get management to agree and understand their responsibilities.
What kind of responsibility?
Things like management confirming they're responsible for preparing accurate interim financials, that they have good internal controls, that they'll give the auditor full access to information, and importantly, that they'll include the auditor's review report if they publicly state a review is done.
Got it. Mutual understanding.
Exactly. And this is usually formalized in an engagement letter.
Okay, the engagement letter, what does that cover?
Its main job is to reduce misunderstandings. It lays out the objective, basically, to figure out if any material modifications, meaning significant changes or corrections, are needed for the financials to align with the accounting rules. It also clearly states that this is done primarily through inquiries and analytical procedures.
Not deep testing.
Right. And it's crucial. The letter says a review is much less extensive than an audit, and therefore the auditor will not be expressing an opinion, just that limited assurance.
Okay, so setting expectations clearly. And once those rules are set, why is it so important for the auditor to really understand the company, even for this, like, interim checkup?
It's fundamental. The better an auditor understands the company, its business, its industry, how its internal controls work, the better they can spot where things might go wrong.
Makes sense.
This understanding helps them figure out, what types of misstatements could realistically pop up, and then choose the right procedures, the best questions to ask, the right numbers to analyze. It's about knowing where to focus their attention.
So how do they actually get that understanding, especially if it's their first time reviewing this company?
Well, they start by looking at past records, previous audit or review work papers, the most recent annual financials, and comparable prior interim periods. They also talk to management, asking about any significant changes in the business, operations, or internal controls.
And for a first-timer?
For an initial review, they'll usually, with the company's permission of course, reach out to the previous auditor.
Talk to the predecessor.
Exactly, and review their documentation. It helps them get up to speed faster. But it's important to remember the new auditor is still entirely responsible for their own work and conclusions.
Right. Okay, this next part sounds a bit like detective work. What specific questions do they ask, and who are they talking to?
It definitely has that element. Auditors aren't just buried in spreadsheets. They talk to the people involved. Mainly, they direct their questions, their inquiries, to management members who are responsible for financial and accounting matters.
What are they asking them?
And things like, are these financials prepared according to the rules? Were there any unusual or complex situations? Any big transactions near the end of the period? Also, critically, have you found any uncorrected misstatements? Any known or suspected fraud? What about significant journal entries? Any communications from regulators?
Wow. Okay.
And they ask about significant deficiencies in internal control, any changes in related parties, and this is important about the company's ability to continue as a going concern.
The going concern issue. That's always a big one. How does that work in a review versus an audit?
That's a great point. A review isn't designed specifically to find going concern problems. However, if during their work substantial doubt does come to the auditor's attention,
Then what?
then they must ask management about it and consider if the company has adequately disclosed the situation in the financials. But unlike an audit, they generally aren't required to perform procedures to, corroborate management's plans to mitigate the issues. It's more about awareness and disclosure.
Got it. Okay, so they've asked a lot of questions. Now, what do they do with the actual numbers? How do they decode them?
That's where analytical procedures come in. This is less about checking individual invoices and more about spotting trends, patterns, and unusual relationships in the data.
Like comparing things.
Exactly. They compare the current interim numbers to, say, the immediately preceding interim period or the same period from the prior year. They also consider plausible relationships. How should revenue relate to cost of goods sold, for example, both financial and sometimes non-financial data. And they compare the company's reported numbers and ratios to the auditor's own expectations, though these expectations are generally less precise than in a full audit.
So looking for outliers.
Pretty much. They might look at revenue broken down by month or by product line to see if anything jumps out as odd. The goal is to identify things that warrant asking more questions without doing that deep transaction testing.
Okay. Are there other essential things they just do as part of the review? Other standard procedures?
Yes, there are a few others. They'll typically read the minutes from meetings of stockholders, the board of directors, key committees, because important decisions are often recorded there.
Right. Things that affect the financials.
Exactly. If the company has subsidiaries or components audited by others, they might get reports from those auditors. They also need to obtain evidence that the interim financial information agrees with or can be reconciled to the company's accounting records. And they'll ask about the reliability of those records.
Just basic checking.
Yeah, and they read the interim financials themselves to see if they appear to conform to the accounting framework. They'll also read other information included in the same document just to check for inconsistencies or potential misstatements of fact. And of course, if any questions come up from their inquiries or analysis, they need to perform additional procedures to resolve those questions.
Okay, this next one sounds really important. The client written representation letter. What's that?
Oh, it's critical. Absolutely required for review, just like for an audit. It's a formal written statement signed by management.
What does it say?
Essentially, management affirms key things about the financial information that they've provided everything, that it's complete, that transactions are properly recognized, measured, and disclosed according to the rules, that subsequent events have been considered, basically taking formal responsibility.
And what if management refuses to sign it? Or the auditor has doubts?
That's a huge red flag. If management refuses, or if the auditor has serious concerns about their integrity based on this or other findings, the auditor needs to discuss the matter, reevaluate management's integrity, and seriously consider withdrawing from the engagement. You can't complete a review without it.
Wow, okay. So all this information comes in the questions, the analysis, the rep letter. How does the auditor pull it all together and decide what it means?
This is where their professional judgment really comes into play. They gather all the misstatements they've found, whether it's a wrong number or, say, inadequate disclosure, and they evaluate them, both individually and all together, in aggregate.
To see if they're material.
Exactly. The big question is, do these misstatements mean that material modifications are needed for the financial information to be presented fairly
Right.
according to the accounting rules? And critically, if there's a scope limitation like they couldn't perform a necessary procedure or management didn't provide that representation letter, the auditor cannot issue a review report, period.
What do they do then?
They have to communicate that fact and the reasons why to management and also to those charged with governance, like the audit committee.
Okay, and finally, communication. They have to tell people what they found, right? Who do they talk to?
Yes, communication is key, and it needs to be timely. If the auditor thinks material modifications are needed, they tell management promptly. Or imagine if an issuer filed their quarterly report before the review was even done. The auditor needs to let management know immediately.
And if management doesn't respond?
Then the auditor escalates it. They inform those charged with governance again, usually the audit committee. If they don't respond appropriately, the auditor has to consider more serious steps, maybe even resigning and consulting legal counsel.
Serious stuff.
Definitely. They also have other required communications with governance, similar to an audit, about things like potential fraud, illegal acts, or significant deficiencies or material weaknesses they found in internal control. And if they can't complete the review for some reason, they have to communicate why, state that no report can be issued, and mention any material modifications they did identify.
Okay, so assuming they can issue a report, what does the stat review report actually look like? How is it clearly different from a full audit report?
The language is very distinct. For a private company, a non-issuer, the report will have a conclusion that says something very specific, like, based on our review, we are not aware of any material modifications that should be made to the accompanying interim financial information for it to be in accordance with the accounting framework.
Not aware of any material modifications.
Okay. Right. And importantly, it will explain what a review involves, primarily inquiries and analytical procedures. It will state clearly that a review is substantially less in scope than an audit.
And therefore,
Accordingly, we do not express such an opinion. That no opinion part is fundamental.
right, only limited assurance.
Exactly. Oh, and a small but important detail, ideally, each page of the interim financial information itself should be marked unaudited.
Good point. And for public companies, issuers, is it similar?
Very similar in substance, yes. The report follows PCAOB standards but reaches the same type of conclusion. The auditor is not aware of any material modifications. It also includes that explicit statement about being substantially less in scope than an audit, and that, accordingly, we do not express such an opinion. The core message is consistent.
What happens if the auditor does find something materially wrong? Like a required disclosure is missing or they use the wrong accounting principle?
If the auditor finds a departure from the accounting framework like that and it's material, the report must be modified. They add a paragraph describing the departure and its effects, if known. Then, the conclusion paragraph is modified to say something like, based on our review, with the exception of the matter described in the preceding paragraph, we are not aware of any material modifications.
So they flag the specific issue.
Yes. But if the issue is so pervasive or significant that just modifying the report isn't enough to communicate the problem adequately, the auditor might have to withdraw from the engagement altogether.
Okay, and what about going concern issues? Do those show up in the review report?
They can, yes, but the rules differ slightly. For private companies, a specific going concern section is added to the review report if, for instance, the prior year's audit report had one and the condition still exists, or if management explicitly states there's substantial doubt.
And for public companies?
For issuers, the auditor generally doesn't add a paragraph about going concern in the review report if the company's own disclosures about it in the financials are adequate.
But what if the disclosures aren't adequate?
Well then, for both private and public companies, if the auditor concludes the disclosure about the going concern, uncertainty is inadequate, that's considered a departure from the framework, and the review report must be modified to highlight that inadequacy.
Got it. Okay, so thinking beyond just the review report itself,
Yeah.
where else might this interim financial information pop up, and how does that affect the auditor?
Good question. Interim financials often appear alongside the annual audited financial statements in, say, an annual report.
Right.
Normally, the main audit report on the annual financials doesn't need to mention the interim review in that case, unless there's an issue.
Like what?
Like if the interim information included isn't clearly marked unaudited, the auditor might then have to add language to their main audit report disclaiming an opinion on that interim data. Or if the interim information included seems not to conform to GAAP and there's no separate review report presented that addresses it, the auditor would typically add an other matter paragraph to their audit report drawing attention to this.
And for public companies and SEC rules?
For issuers, if SEC-required quarterly information hasn't been reviewed when it should have been, or if it's omitted entirely from the annual report document, the auditor's report on the annual financials must include an explanatory paragraph highlighting that omission or lack of review.
Okay. And what about things like registration statements when a company is issuing stock?
Right, that's another key place. If an auditor's review report on interim financials is included, or even just referred to in a registration statement filed under the Securities Act of 1933, the prospectus document must contain language clarifying that the review report is not considered a report or part of the registration statement under the liability sections of that act. It's a legal protection, highlighting the lower assurance level of a review compared to an audit in that high-stakes context.
Interesting distinction. Okay, let's zoom out and put this into perspective then. We've talked audit, we've talked review. Where does an interim review fit on the overall spectrum of financial scrutiny?
That's a great way to frame it. If you think about the different levels of service an accountant can provide regarding financial statements, you generally have a hierarchy. At the base, you have preparation and compilation. These are really about helping management put the numbers together. They offer no assurance at all. The accountant doesn't verify anything.
Okay, no assurance there.
Then you step up to review, which we've been deep diving into. This provides limited assurance. Remember, it's mainly inquiries and analytical procedures. It's designed to see if any material modifications are needed. Independence is required here.
Limited assurance requires independence. Got it.
And then at the top, you have the audit. This provides reasonable assurance, a high level, but not absolute, that the financial statements are free from material misstatement. It involves much more extensive procedures, testing details, confirmations, understanding internal control deeply. Independence is absolutely critical.
So the review really carves out that specific middle ground.
Exactly. It bridges the gap.
Yeah.
It's more than just compiling numbers, providing some level of professional scrutiny and assurance, but it stops well short of the rigorous examination involved in a full audit.
What's fascinating is how it offers that targeted level of confidence, right?
Yeah.
Allowing people to look at quarterly numbers with some comfort without the full cost and time commitment of an audit every 3 months.
Precisely. It's designed to enhance the credibility of interim information, acknowledging it's a quicker, less intensive process than the big annual checkup.
Okay, so to quickly recap then, we've unpacked what an interim financial review actually is, that essential mid-season financial checkup.
Right.
We covered who needs them, especially that key difference between private and public companies and the SEC's role for the public ones.
Right.
We walked through the auditor's playbook, the understanding, the inquiries, the analysis, the communication, key steps, and we really highlighted how a review differs significantly from a full audit, primarily offering that limited assurance, not a full opinion.
Absolutely. And maybe this leads to a final thought for you, our listener. Knowing now that an interim review offers only limited assurance, not that high-level audit opinion, how does that change your perception when you read a company's quarterly report? What new questions might you ask next time you see financials marked reviewed instead of audited? Something to think about.
Really powerful questions to consider. Well, thank you for joining us on this deep dive today. We really hope you feel much more informed and ready to keep exploring the fascinating world of finance. Keep asking questions and stay well informed.